What Your Bank Doesn't Tell You, a podcast by You Mushroom.
Hello, everybody, and welcome back to our podcast, What Your Bank Doesn't Tell You. We are at the beginning of 2025, and after a year which went very quickly, 2024, at least for me, I don't know how it was for you, Luba.
Same. Hello, also from my side, and very happy to welcome you back in our podcast. Well, 2024 literally went by like in a glimpse.
Mm-hmm.
What do you think? What did it mean for you, Tonia?
Well, for me, if I look at the world, then of course we are in a completely different situation these days. So we had last year elections in 70 countries. This means a big part of the world has a new government or is in the formation of a new government. Then we had central banks changing their policies. So before we had rising interest rate, now we have interest rates which are coming back to lower levels. And yeah, there were big developments on the technology side.
Absolutely. I like, by the way, the surprise of the Japanese National Bank. They were the coolest. No one expected out of the blue. And they ruined the trade of a lot of hedge funds. And
well, at least it reminded us that there is something else than just the bull market.
True.
That corrections are kind of reality as well.
Yeah, absolutely. And a very valid point, particularly given where we stand today. Since the lowest point of S&P 500 in October 2022, around 3,570 something, we have risen almost 70% up. Mm-hmm. And it's really crazy. We're in the middle of a very strong bull market. I think the first year we had roughly plus 20%. This year we are around plus 30%. Price earnings ratio is close to 30. It is out of any type of ranges and bounds. Markets are very expensive in absolute and relative terms. And there are a lot of questions. But again, back to 2024. For me, 2024 was the big year of artificial intelligence and the dawning of quantum computing, which makes me personally very happy.
Yeah, I know you're a tech freak, but maybe just to add one figure of the interesting figures you mentioned before in respect to the performance of the S&P, we can also say S&P has doubled in more or less 4 years.
Yes.
And this is incredible.
Yes.
But I agree with you. Some part was kind of driven bottom up by technology like artificial intelligence. And very recently, I also read a study that basically many economists, they divide the economy in kind of the AI economy and the rest.
Yes.
And basically the rest was more or less consistent throughout the globe with a 2-3% growth rate on average. And AI was just a different story in the end.
It is, and I think it's a big technical revolution which is happening in the data storage and data transformation, and it's even more obvious with the not only with the showcases of NVIDIA and permanent multiplying of amount of data which can be stored and processed and visualized and used for learning purposes, for machine learning, etc. But what is very interesting is also what's happening in the quantum field. And there, I think we're going to see even a bigger jump than in artificial intelligence, because computers would process and solve information and solve tasks which so far are actually not solvable with our binary system. But one thing which is really striking and which we keep talking about is the fact that we are actually, in the meantime, completely out of cycles.
Mm-hmm. I agree. And you mentioned technology and that we even see bigger potential on quantum computing. I agree. But what we have also seen is that a big part of the economy, and that might be one reason why the rest of the economy was performing more or less the same way, is driven by central banks and the policy, and to what extent central banks support the markets. And we have seen that if markets are a bit cranky, that usually central banks, they jump in and they lower rates again. And we have seen that very clearly also in the US. They lowered interest rates in September by 0.5% because markets were a bit choppy, even though there was economically no obvious reason for that.
I agree. And the markets are kind of, as you correctly say, the moment the markets scream, they're like, this little spoiled child, I want my toy, and the Fed delivers the toys. And I'm very happy to hear what Paul said yesterday, because he kind of put a little bit of a discipline to the moods of the markets and saying that, yes, we will make sure that financing costs are reasonable, that we are not going to drag the US economy into a recession, that we're not try not to kind of really slow down growth too much. But the inflation rate target of 2% seems, in my view, not anymore realistic. I think the long-term equilibrium is moving towards 3-ish. And one of the major points is, we saw raise of the sources of inflation, right? Either it's an endogenous shock or it's just a very, very speed up demand, which raises the prices. And what we see are two particular very interesting fields. One is the energy prices, it quieted down, it's a non-show anymore. But the other part of the inflation drivers is the work market, the labor force market. We saw increase of wages. Thanks to the fact that emigration in the US is still in a balance and the huge demand to for workforce can be absorbed, there was not a further raise, even stronger raise of wages. But if that stops, we're going to have a huge issue there. And in addition to that, the biggest driver of inflation currently, the housing market. It's not under control yet.
Yeah, I think here we are also in the middle of our outlook or what we are expecting for 2025. And as you say correctly, so under the new government, especially in the US, immigration might be lowered or maybe not stopped, but we won't see the same immigration, I assume. So as you say, labor costs might increase. Then there are the talks about the tariffs. Also, in case the tariffs are really put through, then this could be an impact on prices. Yes. So as you say correctly, inflation is not gone. We might not see the 10% levels as we had 2 years ago, but still, as you say, we are not back to 2%. And somehow, I believe the market gets used to, if it's not exaggerated, then it's kind of acceptable. But we also have to see that even if we have 2.5% inflation, this is kind of a destruction of our savings or a destruction of debt. And I believe this is a big argument also for the government to have even a slightly higher percentage term of inflation than the 2%, because we have this huge debt of the US government, but also other governments. And if you have a bit higher inflation, then you kind of get rid of the debt without doing anything.
Absolutely. And this is a very, very, very strong argument which you're raising. Who profits from high inflation? And these are the governments who are the biggest debtors. And I think we're talking about 3%, but the unofficial inflation is by far higher. Health costs are rising. And I read today an article in Wall Street Journal that apparently the amount of the annual raise of healthcare costs in the US is tremendous. Food prices are rising. Wages compensated partially, but this is an upward trend, and it actually helps governments really to deal with 36 trillion debt, which they have.
Yeah, it's good of our daily lives, which increase more than it might be measured by official data. But then as well, it's the asset inflation. So what we have seen in the financial markets, and here we are back in respect to the impact of central banks on the financial markets. Given the liquidity is always provided to the market, it's also very tempting to be invested in equities, to be invested in real estate. So housing is getting more expensive. So in my opinion, I have the impression that also this year, even though Powell is a bit maybe more cautious with his outlook, that in the end, if it's really required, the Fed will always deliver the liquidity to the market so that markets don't really properly correct.
They kind of don't have a chance, actually, because they're under a lot of political pressure, under a lot of pressure from the different lobbies. And let's be honest, the Fed is not independent.
No. And in the end, it's also maintaining an entire system. So we have the system with debt of the governments, debt level which are at all-time highs. So somehow this entire system needs to be maintained. If we really allow a correction, then I believe nobody knows how this correction could really look like and how harsh it could be. So in my opinion, the central banks, the governments, etc., they just try to maintain the current situation, and for that liquidity is required. As long as we have liquidity in the market, usually stock markets are supported as well.
Absolutely. So what can we expect for the stock markets in 2025 in your view?
I think consequently it will be kind of stable, and we will see higher stock prices at the end of 2025, unless the real correction is allowed, but I highly doubt. But I assume stock prices will go higher. But then I also believe that it might be different sectors, different stocks also within a sector, which might be the drivers. So we have the new government in the US. We have, just to name an example, we have, or I assume we might have a different health policy in the US. So this could imply that completely different healthcare companies will be in demand, because they might have medicine which weren't interesting before to the government, or to the previous government, and now to the new government. Suddenly it might become more interesting, and healthcare companies with very traditional medicines might be questioned more. So I believe within a sector, but also the sectors in general, might see a bit of shift.
Yes, that's true. There will be definitely a shift, even with in well-established sectors like the information technology, the semiconductors. How definitely it's just due to the fact that it's a completely different government prior to, not anymore the Biden government. What's going to be very interesting is also, are we going to continue in the bull market? And I believe the third year is a little bit of a make it or break it year, typically, if we trust the history. We had 11 bull markets until now, and pretty much all who continued longer than 2 years actually had a choppy third year and corrected more than 5 or 10%, or even 10%. But on average, we need to remember, history teaches us that the average bull market is 6.5 years. So actually, it's a buying opportunity if we believe history, and if there is nothing dramatic happening, like geopolitical shocks and any other nature catastrophes. But I also believe that we may have a choppy 2025 in the first quarter. Towards the end, we might see even 7,000 levels of S&P 500.
What is your view about Europe? Because also in Germany, in France, we have a new government, or we will have a new government.
We want to see first that till we get the new government.
So you're cautious?
Europe, Germany is in a recession. And it's interesting, it's driven by some few, the DAX actually didn't have a bad year after all, which shows that even bad politics cannot ruin engineer art in Germany, which is a good sign. But it's driven mainly by the global companies and global technologies. If China closes, and they are on the way to close even more because of the economic conflicts which we have with the US, we may see an issue there as a Europe. Because let's see, we export mainly to US and Asia. And if US puts this average, I believe for Europe it would be the average 10%. Luckily, we're not Canada or Mexico or China. It still has a huge impact midterm on our production. And given that also China is going in this direction, given that China is very much focused on developing their own market, yeah, I think Europe may see an issue there. And I'm not particularly bullish on our good old continent for 2025.
Let's see. I think over the past few years with the last government, especially in Germany, there was so little progress. Or let's put it differently, the government didn't make it easy for the industries to really flourish. And I could imagine that there might also start a counter trend, maybe more bottom up than from the government. But maybe it's also just a hope from my side that kind of there is this force bottom up trying to get more productive again, and to force the government to support the industry, the economy a bit better again. But we will see. Also for Switzerland, I have very mixed feelings. I have high trust in the smaller or mid-cap companies. I have big question marks when it comes to the three big ones like Nestlé, Roche, Novartis. Also, when we have a look at the bank analysts, they are also very cautious on the big three.
Yes, completely agree. It very much depends on Switzerland, which segment we are talking, and small and mid caps who are not so dependent on exports are actually a very good bet because they're typically solid financed. They're beautiful names, very interesting names, which are currently going through a turnaround. And if they make it, there is a big upside potential. These are very solid built businesses. But one thing is the fact those are not scalable platform businesses. It's still, a lot of them are still the old economy, which is, I think, where the big jumps in development, in growth is missing. And fact is, we don't have a lot of platform businesses in Europe compared to the US, where it's also a different type of market. And with respect to the Europe, I think we should IPO the European bureaucracy that is growing steadily. It is such a bull market there.
Would you buy the stock?
Immediately, in terms of growth rates. I think solid competition to Amazon.
Maybe one other continent which we didn't touch so far is Asia. Oh, yeah, we briefly mentioned that China might be a bit more protective as well, also as a reaction to the US, maybe. But still we have seen, especially technology in Asia, in China, hasn't done the same moves as the US technology companies. And you as a technology person, what's your view on that?
I think they're sorting themselves out this year. They're kind of trying to sort a lot of, that's actually a German expression, die sortieren, sie sind am Aussortieren. They're kind of putting an order and trying to find, to recalibrate actually is the right English expression, what I was looking for. There is a lot going on with Alibaba, there is a lot going on with Tencent, TikTok stories, banning, not banning, then banning. And I think they're going to reallocate resources, but let's not forget the Asian market, and particularly India, even more so than China, are multiple times bigger than US and Europe together. In terms of purchasing power is a little bit of a different story, but I think long term, there is a lot of potential on the tech market, particularly in China and India. And China has one big problem on the tech side, which they're trying to sort out, and it's only a question of time that they sort it out. They don't have access to high-profile semiconductors as the US has through Taiwan, and Taiwan produces 90% of the most enhanced semiconductors. And I think that could be short-term a little bit of a bummer, but it's going to be solved. And the government invests. Another factor, it's also element of technology is the electronic vehicles. And BYD is doing an amazing job to overtake substantially Tesla there. And the government.
I also agree that technology companies based in Asia supporting this global trend of AI, they might catch up a lot. But I also believe what we shouldn't forget, even though if China and India has a big domestic potential because they are just incredibly big economies, they also have a completely different structure than what we are used to. And I believe this is also a challenge for these markets to be really efficient and to grow the same way as it is possible for Western countries. And I believe this could be a bit, or we could easily overestimate the potential because we just assume they work more or less the same way as we do, but they don't. So even though I'm a big fan of India, I'm personally a bit cautious in investing at this point in time, even though midterm I absolutely see the potential. But I'm also positive, as you mentioned, on the technology companies, maybe even further east in Southeast Asia or China, in respect to be a player in this global AI story.
Very interesting, yeah. We'll see what's happening there. And Japan is another animal. It's a little bit decoupled from this type of development. It's interesting how the policy of the central bank will continue. And I think there from the car industry, we may see some very interesting developments as well. What to me is still a very big question mark is, do we price credit risk correctly? Maybe to move out of the equity world, which we love a lot, and where the show is happening. it's very interesting too. I have the feeling that we substantially misprice credit risk across sectors, across capital structure,
Across governments.
across governments. Yes,
I agree. And this is, in my opinion, part of the loose monetary policy, or it's kind of another way of expressing asset inflation.
yes.
Because there is no choice, there is not enough ways to invest, also kind of relatively seen conservative ways to invest. So everybody is chasing the bonds and credit spreads are tightening.
The bond market apparently so officially ended in 2020 on the bond side, the bull market on the bond side. Apparently the longest for roughly 40 years. And what is interesting now is to see, but I think it was reflecting properly it was because the spreads were getting tighter and tighter. We're still very early in the curve to see if there would be a normalization in terms of credit spread pricing.
So with normalization, you mean a widening again?
Yes.
Yeah.
Yes.
Even though the widening would be justified in respect to balance sheets, etc., I don't see a widening of the credit spreads just because bonds are bought because the cash needs to be placed somewhere.
Yes, and also I think because of the control of interest rates, which is technically, given inflation, given embeddedness, there is no justification that the US rates are currently where they are.
No.
If that would be a regular company, that would be classified as emerging market, probably sub-investment grade, and we would see completely different pricings. And the mispricing on the credit side already starts with the governing interest rates, in my view.
Yes, I agree. The interest rates which are too low force basically market participants to take more risk.
Absolutely.
Or to buy basically anything what is available to any price, more or less.
I agree. And from credit perspective, from the perspective of how a government actually is a government really able to serve that? In certain countries, particularly in the USA, credit risk is severely underpriced.
It is. Imagine if the US government would need to get rid of the debt amount. This is a mission impossible. They'll never get rid of it.
Luckily, we don't print it because I don't think we have so much forest. That would be a huge issue for the Green Coalition.
So, but you see, we are kind of optimistic that markets, you are a bit more cautious than maybe I am, but overall, I think we can expect, or if we talk in 1 year's time, I believe we are higher in stock markets. We are still kind of tight on the credit spreads. And gold, one of my favorite topics. I'm still supportive for gold, or I don't see a reason why it should decline in price. Also, to a certain extent, the inflation considerations which you mentioned before. So I think we will see a bit more of the same also this year.
I think so too, and I think what we're going to see is a very huge dispersion. Where I particularly strongly believe we're going to see much higher levels is the US on the equity side. And we're going to have a beautiful tech stories, beautiful growth, a lot of innovations. And this is the one side of the equation where growth is really, and prices are justifiable. On the other side, because there is such a divergence between traditional and high-flying techs, there is a need for stability. And we would see these two mindsets, two extreme mindsets, run for growth and at the same time having a very solid footing, very, very conservative investments like, for example, gold, although I don't think gold we can call it in the meantime conservative, and particularly also even cash parked at certain saving amounts, just to have a little bit of a balance. You don't have interesting opportunities on the fixed income side, so what do you have? Cash and gold. But then again, you don't want to miss the big technology revolution, so it's the big tech. And you're right, where I'm particularly cautious is Europe. Not US, but really Europe, because I think we're missing a lot structurally. We're missing a lot in terms of growth. We have a very diverse political spectrum. And one thing which is very scary for me particularly, we don't have the right work attitude and we are very complacent as a continent. And workforce next to capital is actually the driver.
I think this is a beautiful closing word. I hope you enjoyed this podcast. We are very curious to hear about your opinion for 2025. Write us at hello@yourmushroom or below in the comments. And we are very much looking forward to see you soon. Thank you.
Thank you and happy holidays.
Money!
What Your Bank Doesn't Tell You, a podcast by YouMushroom.